In this video, we're going to discuss temporary and permanent differences between book income and taxable income. Now remember, book income and taxable income are not the same thing. They're not equal to each other in the United States because book income refers to income reported in your income statement for financial reporting purposes, whereas taxable income is reported to the IRS to determine how much money a corporation owes in taxes. So they have different objectives and they're calculated in different ways. So they're not the same thing in the United States. Now, these differences between book income and tax income could be either temporary, in which case they will reverse in this future period, and ultimately the same amount of deductions are taken. It's just a timing difference. Or it could be permanent difference, in which case there's never going to be a reversal. For example, income from life insurance proceeds is never going to be taxable. It's never going to be part of taxable income. However, it is part of book income, and that's not going to reverse at any point in the future. So I want to give you an example to show you the difference between temporary and permanent differences in taxes. So let's say that you purchase a fixed asset, some depreciable asset for $60,000, and you estimate that it has a useful life of 5 years. And so we're going to look at how the differences in depreciation for both book and tax purposes can create a situation where we have a temporary difference. So let's say that we decide for book purposes, we depreciate this asset over 5 years. And so we've got year 1, year 2, year 3, year 4, year 5. Let's say there's no salvage value. So we do straight line method. 60,000 divided by 5 is 12,000 of depreciation taken every single year for each year that we have the asset, right? Now, let's say for tax purposes, usually tax, it accelerates the depreciation. This is actually, it's basically the government is doing a favor to businesses to encourage them to invest and to accelerate their deductions so that they get the same number of deductions. They still are depreciation. If you add up all the depreciation, it's $60,000 over the life of the asset. So they're still taking $60,000 in deductions, but they're going to take the deductions in larger amounts in earlier years and then in lower amounts in later years. So it's accelerating the deductions because the time value of money, it's basically a good thing for this business, right? So they're going to get to deduct $20,000 in year 1. However, the amount that they deduct goes down over time, and by the end of the final year of the asset, they only deduct $4,000. So if we think about the extra deductions of taxes over book deductions, we can compute it by saying, okay, well, let's take this 20,000 minus the 12,000. And so in year 1, the excess of tax deduction over book is 8,000. So that means, according to tax purposes, there's a difference of this 8,000 extra deduction, and because there's 20,000 of tax depreciation versus 12,000 of book. Now, in year 2, it's going to be 4,000 excess of tax over book. In year 3, it'll be 0. There's no difference. And then in year 4, it's actually going to be book. Book ends up with more in deductions. And then in year 5, it's 8,000. Now, if we add up this column right here, it's going to give us, if we have 8,000 plus 4,000 is 12,000, minus 4,000 minus 8,000 is going to give us 0. And what you'll see is that we've taken 60,000 in depreciation each way. So if we look in year 1, and you say, hey, look, we took the different amount of depreciation, but later it reversed. It reversed later. So that means that basically we have a difference in year 1, right? But it's going to change later. So what we actually have is a thing called a deferred tax liability. And we'll talk about deferred tax liabilities and deferred tax assets in a future video. But I just want to share with you now that this 8,000 and this 4,000, those differences, they later reverse. So it's simply a timing thing. In each case, whether it's tax or book, we end up taking a total of $60,000 in deductions. And so that is a temporary tax difference because it reverses. Okay, now sometimes you'll have a situation where there's a permanent tax difference, right? So a permanent tax difference is never going to reverse. So it's not going to be like, oh, well, we're going to take more deductions in year 1, but then less in year 5. A permanent difference never reverses. So I want to give you an example. We'll take the example of the life insurance proceeds. So let's say that you and I start a band. We start a band called Rock and Roll Incorporated, and we get insurance on each other, and you get insurance on me. I'm playing the guitar, and you say, hey, look, if this guy dies, I could have an issue here. So you get life insurance. You get life insurance on me, a life insurance policy. And then let's say that I die in a tragic accident trying to climb the St. Louis Arch with suction cups. I try to climb the arch, and I end up falling and dying, unfortunately. But the company, because you have this life insurance policy, you get $2 million. So you receive $2 million. And now the question is, okay, well, what happens to that $2 million? Is that income? So that is not taxed, right? So $2 million is tax-free from the perspective of when you're filing the corporate tax return, because life insurance proceeds are exempt from taxable income. So this is going to be tax-free. However, when you're putting together the financial statements, and calculating pre-tax financial income, you're going to include that $2 million. So we say for book income purposes, we're going to have $2 million in income, right, because of this life insurance proceeds. But for tax purposes, this transaction, this life insurance proceeds, is actually going to give us 0, right? So there's no income recognized for that $2 million. Now here's the thing. This is permanent because it never reverses. It doesn't matter. So once this transaction happens and the $2 million is done, it's not like, 5 years later, then there'll be $2 million of tax income and 0 of book. It does not reverse. And so that means it's a permanent difference. This life insurance proceeds is going to create a permanent difference between book and tax income. And for that reason, we're not going to create a deferred tax asset or deferred tax liability, which we're going to talk about in the videos to come.